Hi fellow traders, I'm making this video to share my EUR/USD analysis and trading plan with you. If you have watched my previous analysis of EUR/USD, which was based on ECB monetary policy, I had told that EUR/USD will probably hit 1750, and then we had commented on the post on our forex analysis page that 1750 is more likely to be hit because ECB had not tapered their quantitative easing. So let's go back to daily time frame, and this is the 1750 level which we had told that the EUR/USD will touch. So definitely EUR/USD touched this this 1750 level, and now the background for formation of head and shoulder has been almost completed. So this is the left shoulder, I mean inverted head and shoulder. So this is the left shoulder, this is head, this is the right shoulder, and market should return from here to the upside for completion of this head and shoulder pattern. Classical approach of trading a pattern says that we should wait for completion of the pattern and then we should trade the pattern. So if we follow the classical approach, we should wait for EUR/USD to go back to this area around 119, and then this 119 line will become the neckline of this head and shoulder, and then we should wait for a daily candle to close above this 119 line to validate the breakout above the neckline to take any buy entry. So it will take many days to go to the neckline and break the neckline. So that's the classical approach, but today I'm going to talk about trading an under formation pattern, which I call trading and trading of under formation pattern. So this the pattern of this inverted head and shoulder is still under formation, and it will be from it will be completed when the EUR/USD will touch this 119. But we are going to already buy EUR/USD in anticipation that this pattern will be completed. For this purpose, we'll go to the 1 hour time frame and we will look at any possible buying opportunity, whether it's a candle pattern or it's any criterion which we see on EUR/USD. So our criterion on EUR/USD should be at least RSI crossing above 50 line, or at least a moving average crossover. None of these criterion have been met by the market yet. However, there is one thing which we can consider now, and that is candle pattern. Let's look at these three candles. This is a bearish candle, this is a small body candle, some sort of tiny hammer, and this candle should have closed at least above the mid of this bearish candle to form some sort of morning star or morning dozy star, because this candle looks like a dozy. This candle is already trading above the midline of this bearish candle, so we should wait for closing of this candle, which is right now trading at 1766.9, and then we should enter the buy position. Now is the time to talk about our exit. Let's talk about the exit. For the exit, we should either reach a target or market should invalidate this setup. So let's talk about the risk first. If market is going to invalidate this setup, then a daily candle must close at least must close below this 1750 area at least by more than half of the number of pips involved in this candle. So there is no fixed formula to find out whether this pattern has been invalidated, and we cannot say that the shoulder should exactly be formed at 1750. Even if market will go to 1740, 1730, and it will return to the upside, this inverted head and shoulder will still be valid. But if it deviates by a huge degree from this this 1750, which is looking harmonic with the left shoulder, so then this head and shoulder pattern will be less likely to be formed, and the shape will be it will not be able to make a good shape will be disformed. So that's why we should figure out a number of pips by which it should go below 1750 to invalidate the formation of head and shoulder. Shall we say that if market will go to 1720, then the head and shoulder has been disformed, or shall we say that if market goes to 1710 and then we say that the candle has been disformed. So there is no fixed formula, so we will try to figure out a way to define what price level should it touch to invalidate the formation of inverted head and shoulder. So I'm going to use average true range for this purpose. So I'll insert indicators, average true range, and I will take an average of 5 days. So this is giving me an average of 44 pips. Sorry, I'm looking at the wrong place. I should look at the ATR. ATR. So ATR is giving me average of 48 pips. You can see this 0.0048. It means the average of 5 daily candles is 48 pips, and half of 48 pips is 24 pips. So I'll say that if market goes below 1750 and closes beyond 24 pips, then I should say that the formation of head and shoulder is not going to take place. The shape is not proper if market goes below 1750 minus 24. So let's place the calculator here on, let's open the calculator. 1750 minus 24, so I need 1726, and I need a closing of daily candle below 1726 to strongly say that this formation of head and shoulder, inverted head and shoulder, is not going to take place. Sometimes market goes down, it makes a spike, it returns back, and the real body doesn't look like it's invalidating the shape of the head and shoulder. So we need to consider the real body of the candle, not just the spikes. That's why we need daily candle closing below 1726. And if a daily candle is closed below 1726, then we will exit our trade. So this is our risk. Now let's come back to 1 hour time frame and let's figure out what can be our entry point. So right now price is trading around 1763, and it's gonna take 3 minutes to close the candle. This is 10:57 a.m. So let's say it will stay around 1764. So from 1764, roughly let's say 1766, because we are gonna buy at the ask price, and what we see on the chart is a bid price, and obviously ask price will be something around 1 pip or 1.5 pip higher than the bid price. So our entry will be something around 1766, and from 1766 to 1726 we have a risk of 40 pips. Market can close a daily candle maybe 10 pips or 5 pips below 1726, because our criteria, we have figured out that we need a candle closing below 1726 on daily time frame. So it can close at maybe 1720, 1716, we do not know yet. So maybe our risk will not just be 40 pips, it may be increased by 5 or 10 pips. So roughly let's say 50 pips will be our max risk. So 50 pips is what we are gonna risk on this trade. And reward, now let's talk about the reward. Even if market is going to continue falling to the downside, it can retrace a little, and retracement can be anything like 50%, 61.8%. Let's try to understand the tendency. So you can see that the market is making deeper retracements after falling. For example, if you look at the movement from here to here, this was a pretty deeper retracement, then there was a downward movement, then it was a pretty deeper retracement to the upside. Almost 88% retracement was this against this previous downward move. So even after this movement, there can be a pretty deeper retracement to the upside, and which can touch something around 61.8% of the whole move down, or even more than that. So if we plot a Fibonacci here, and if we try to figure out 61% of this fall, this is not rise. Let me change this, let me delete this, and this is the fall. Alright, so 61.8%. Market can go and touch this area, but if it will go to 61.8%, this will invalidate the tendency of making lower low and lower high, and then there will be the high chances of formation of the inverted head and shoulder that we were talking about. So let's calculate the number of pips from here. 10:59. I'm going to make an entry. We are getting 86 pip. So market may not go above this high and shouldn't go above this high. If it's really want to continue to the downside, then it should continue in the fashion of making lower lows and lower highs. But we do not need 84 pips or maybe 74 pips or something around like this. We just need 50 pips to make our reward at least equal to our risk. So we are just going to enter at the market. We will set our TP at the 50 pips, and 50 pips from 1766 is this line. 1766 plus 50 is 1816. So we just need this level. And if I plot the all default levels of Fibonacci, this is some coming around just 38.2, slightly above 38.2, like something around 40% retracement of the whole move down. And if I just look at the recent movement, this is coming around slightly above 61.8. So I'm gonna place my target at 1816, and I believe there will be no big issue for the market to touch this area. So let's draw a line. If we draw the trend line, market can go and touch this area before it falls below, because market has a tendency to touch the upper part of the trend line. So it can touch here, and then it may continue to the downside if it's really willing to invalidate the formation of inverted head and shoulder. Otherwise, it can simply continue to the upside and form the inverted head and shoulder. If inverted head and shoulder will be formed, we will talk about the next trading plan, how to further trade this EUR/USD after the formation of head and shoulder. But right now we have this opportunity on the table, and I've just taken my entry, and my entry price is 1763.8. So that's all about this trade. There is no significant news today because core retail sales and retail sales from the US have already been released today, almost 2.5 hours ago, and tomorrow is prelim consumer sentiment, which is not very significant news. And there is another chance that maybe our trade will be already completed before that release. So that's why I'm ignoring prelim consumer sentiment tomorrow, and I'm just gonna trade this plan. So that's all about EUR/USD trading today, and thank you for watching.